I think this slide does a pretty good job of showing how the dynamics or the financial dynamics of real estate projects have changed in the past few years just because of the ongoing interest rates issue. So if you look at the left side, it shows you in 2019, if a real estate project was started in 2019 versus 2023, what are the changes that have taken place? And those are unfortunately adverse changes. So if your estimated development cost in 2019 was 60 million, unfortunately, because of inflation over the years, that development cost has increased to 70 million. Okay. But at the same time, because rates are higher, property values have declined, people are willing to pay less, whether it's for rents or whether for properties outright. Your rental income has also declined. Okay. But at the same time, your costs remain the same, which means that the cash flow that is available to a builder to service the debt after subtracting the costs to operate the property and keeping in mind the lower than projected rental income that the builder is generating, there is lesser amount of cash available to service the debt. Okay. But at the same time, the interest rate costs have also increased. Okay. And this is where there is a high probability of the builder generating a loss. Okay. And that's the thing which investors need to be very careful about when they are thinking about the front end of real estate projects, basically. But the problem comes in situations where there is an oversupply in the market and there are macroeconomic factors which determine that the project is probably not going to be as successful as possible. Okay. And what happens is that what investors are looking at from an EB5 perspective is they are sitting, and we'll come to this later on in the slides, they're looking at sitting in probably the lower end of the capital stack. And the lower end of the capital stack is the riskiest part of that capital stack. Okay, which means debt is the cheapest and it is also the safest because bank debt is often backed by the collateral of the project. But for EB5 investors, they are normally sitting in the mezzanine area of the capital stack. Okay. And mezzanine means that the debt has certain characteristics of, or the capital has certain characteristics of debt, and it also has certain characteristics of equity, which makes it even more risky. So in a situation where the operating costs and the debt service costs are eating into the income that the real estate builder is able to generate, there is a high risk of the builder not being able to return the capital that it has taken from its investors because there is not sufficient cash flow to go around. Okay, and that is a big concern in an environment, in a macro environment like this, that if you have lower income or if you are making a loss because the bank loans need to be repaid, the interest needs to be paid to the bank up front, people who are sitting below in the capital stack are not able to get a return on their capital. Okay, or rather are seeing a loss of capital for the simple reason that the people who sit above in the capital stack have to be taken care of by the builder first. So one thing that I really wanted to talk about in this seminar, and one of the key reasons why I wanted to do this, is because I think there is a very poor understanding of how capital stack works and how financing really works for a real estate project. And you know, this is just like basic corporate finance 101. It's applicable to companies in general also. But I think people need to understand where they sit in the capital structure overall whenever a project is built, and what are the different returns and risk profiles that different levels of the capital stack offer. And a lot of EB5 investors seem to fall into the trap where they are attracted more to the rate of return that the project is offering them versus the safety of capital that the other characteristics of the project, which we have discussed early on in our presentation, offer compared to the return profile of the project. So I think moving on to the next slide, there's a really nice chart which kind of breaks out what the capital stack looks like. So what you are looking at in front of you is a stacked bar chart that shows you what the liability side of a balance sheet typically looks like. So if you've ever seen a balance sheet in your life, you'll see there are three sections. There is assets on the left side, and there is liabilities and equity on the right side. This is only the right side of the balance sheet, because any project or any business in general is financed with either debt or equity or a combination of the two. The two typical positions where EB5 investors normally sit or are offered investment opportunities are the mezzanine and the preferred equity part of the capital stack, which basically goes to show that EB5 investors are usually sitting in one of the riskiest parts of the balance sheet. Okay. Now, developer equity is ideally the riskiest, but that's only because a developer is required to commit some of his or her own capital in a project before the project takes off. So the initial capital provider, being the owner and the manager of the project, will obviously have the highest level of, or the highest allocation of the profitability of the project. Okay. Now, the most important thing which I find investors do not understand in the case of EB5 is whenever you are being offered a certain rate of return on a project, always think about the cost of capital that the builder of the project or the developer of the project is incurring. Okay, there is a wide gap between the return that the EB5 investor is going to see on a project versus the cost of capital that the investor, that the developer of that project is going to incur. Why do I say that? I say that because, for example, there's a EB5 project somewhere in California in a university town where there is student housing being built, and the builder is offering a 4% rate of interest annually to the EB5 investor. Now, the industry standard for high quality projects in EB5 is usually a 0.25 or 0.5% rate of interest. Okay. Now, if that 4% rate of interest is being offered to the EB5 investor, investors need to keep in mind that the EB5 agency, or the facilitator, the regional center, is also making a significant return on the capital that is being invested. Okay, that return on capital being invested is going straight to the regional center, after which another 4% is going to the EB5 investor, which means, let's say, the industry standard, and then investors should read all the documentation that is provided by the regional center. I think it's extremely important to read the memorandum. They should read the debt agreement, the senior loan agreement that any project has. I have come across projects where investors have not been provided the loan documents associated with the loan that the senior lender has made to a particular project. And I have, by God's grace, been able to help those investors to stay away from such projects, because I want to make sure that I know how my capital is going to be treated based on not only the agreement that I have with the builder or the developer. The more risk a project has, the higher the rate of return. And you should also contrast this with the fact that EB5 investors are probably the most powerless class of investors in the US. EB5 investors are not citizens in the US. They are immigrants. They have very little knowledge of how the legal system works. They put their capital into a project which is highly risky because it's opportunistic real estate, where they will sit
very low in the capital stack, in one of the riskiest parts of the capital stack, they are usually not guaranteed any rate of return, and there is also a risk of capital loss. If these are the ground realities of how EB5 investors are treated, then how is it possible that even the easiest set of investors to deal with in the case of an adverse scenario is being offered such a high rate of return? If you just think about this in a Machiavellian sense, that you as a developer or as the owner of a particular project, you have to decide how you are going to treat your customers, your investors in an adverse scenario. You are obviously going to want investors who do not have a lot of power when it comes to extracting concessions out of you in an adverse scenario. And cost of capital varies across different levels of the capital stack. So a senior loan will be 4 or 5%. Okay. But if the mezzanine or the preferred equity investment, which is being taken from a class of investors that does not have a lot of financial or legal sophistication, promises you 10 to 15% rate of interest, or a total 10 to 15% cost of capital, it should ring alarm bells, because that project is extremely risky.
One thing I want to expound on that you mentioned is the importance of seeing the senior loan documents. Could you talk, a little bit more about that? Why is that so important? And in addition to senior loan documents, how critical is it to also see the balance sheet, the financials of the company, and any guarantor company that's securing the repayment of investors' funds?
Yes, extremely important. I think let's hit upon the bank loan documents first. You want to make sure that the bank loan documents do not have any covenants in the loan documents which directly adversely impact people who sit below in the capital stack, people who sit below the bank loan in the capital stack. Now, most banks will not have anything like that. I have personally not seen a loan document which says that, okay, we are going to take away money from the lower part of the capital stack or whatever. Most covenants will just focus on, in the case of an adverse scenario, we expect to be repaid in full of whatever our initial investment was. And the problem, however, is if that adverse scenario does happen, then the bank has the means to actually go and recover as much of its capital as possible. But other people don't, or EB5 investors don't. Now, let's say the bank loan was 100 million, the project fails, the bank is able to recover 105 million. Now, out of that 105 million, the bank is going to take out 100 million. It is probably going to also take out the additional interest that has been accumulating over time. It might also want to take out its legal costs. And then whatever 1 or 2 million remain will go to the investors who sit below in the capital stack. And that 1 to 2 million versus a $50 to $70 million pool of EB5 investments is nothing. You're basically getting almost nothing from the recovery. So that being said, I think it makes it extremely important for investors to demand, in fact, the regional center that is marketing a particular EB5 project to provide the financial statements, or to provide enough information that makes you comfortable with the financial position of the company or the developer's business. Now, in the case of Coulter, for example, I was looking at the Saltair project initially. I changed my mind and decided to invest in Twin Lakes. The one thing that I liked in both these projects is the builder has been very clear about what the financial position of the project looks like. We're being offered a guarantee by a parent entity being set up by the developer with enough assets to guarantee the repayment of the loan. What does that mean? What it means is, let's say Sam and I do a business transaction. Okay, Sam I lend Sam $100, and Sam's partner Mike says to me that if Sam can't give you this $100 back in 10 days, then I'm going to give you the $100. Okay, that's a very simple explanation. And the way it applies to the Coulter situation, or the situations I came across, was all loans, whenever they have a collateral associated with them, have something called as an LTV ratio, which is loan to value. Okay, which means that if the loan is $100, then there has to be a collateral worth $120 backing that loan. Okay, what Coulter did for EB5 investors in the mezzanine debt category was it created an LLC. The LLC was given a certain market value of assets. Those assets could be anything. They could be plots of land, they could be apartments, they could be single family homes, anything. Okay, which were at least 120% in value compared to the amount of money being borrowed by Coulter through the mezzanine debt fund from EB5 investors. So while the money being raised is going towards developing the project, if let's say the project fails tomorrow, then this LLC that is guaranteeing the debt will sell its assets, okay, and repay the EB5 investors of their capital. Okay, that's what it means. I think developer access to capital is probably one of the first things that will determine whether the project even has a chance of succeeding or not. And I say this from the perspective of somebody who grew up in a family in India where my relatives, my father also to a certain extent was involved in the real estate business. We have been significant purchasers of real estate in the past in our family at various points in time. And having observed how a lot of real estate projects, and this is the thing that actually shocked me when I came to the US, is that a lot of developers, even here, are willing to start projects without putting a complete financing package or a financial plan in place when it comes to how they will build the project. A lot of projects are started with the mindset that, okay, we will launch the marketing phase of the project. We will get the first 10% or 20% of the customers to provide us the capital that we will use to build the project, and then we will wait for other customers to come and give us capital to complete the project. Okay, I think that is a very, very dangerous strategy, and one that every EB5 investor should stay away from. If and a few pointers here, if your capital, if EB5 capital is the first dollar to go into building a project, then stay away from that project. There is a scrap iron steel plant that is being built in the US somewhere, I think in like the southwest or some part of the US, where number one, I think just by looking at the documents, I think the terms that were being imposed on EB5 investors were extremely onerous. But at the same time, without having committed capital from the senior lenders in the project, the first dollar to go in was EB5 investors. I just did not see myself ever recommending anybody in good faith to put their money in that project. And we can get to different classes of investors later, but I think a very good sign of the developer being reliable and smart and successful is if a large bank like Wells Fargo, Bank of America, JP Morgan, or any of these publicly listed banks are willing to give a senior construction loan to the developer for a project. Okay, and it may not necessarily have to be just the project where you are investing in, but if there is an established record of the developer raising money from the top banks in the country to finance its projects, that gives you a lot of confidence in the ability of the developer to deliver.
The disclaimer is that what I am doing here today is strictly voluntary. a number of folks have approached me in the past after my first interview was posted, after I filed my EB5 application, to get advice on the projects that they were looking to invest in. And it turns out that some people have the suspicion that for some reason I'm getting paid by EB5AN or any other agency to advise people. And I just want to make sure that I'm very clear about this. I am not getting paid to do any of this. This is purely in a volunteer capacity.